All right, let's dive right into this explainer. We are looking at a true modern financial thriller today. We're unpacking the dramatic, honestly shocking fall of Credit Suisse. It's a textbook case study in how a $1 trillion empire can completely crumble in a matter of days when its foundation of trust just gives away. Because at the end of the day, this isn't just a story about bad math. It is about panic, power, and the incredibly sudden evaporation of a legacy. 160. Think about that for a second. For over 160 years, Credit Suisse wasn't just a bank. It was practically a fortress. It was the absolute symbol of Swiss stability. I mean, this is an institution that survived 2 world wars, the Great Depression, the dot-com bubble, and the 2008 financial crisis without breaking a sweat. They were the ultimate vault for global wealth, managing billions for the world's elite, purely because their name was literally synonymous with safety. Which brings us to a really terrifying mystery. How exactly does a globally critical bank just vanish over a single weekend? Because it wasn't triggered by one bad trade. No, it was a catastrophic, simultaneous breakdown of risk, strategy, and above all else, trust. It was a slow burn that very suddenly turned into a raging inferno. We really need to start this story at the climax. Picture the sheer, sweat-inducing panic in boardrooms across Europe back in March 2023. Over one completely frantic, sleepless weekend, Swiss authorities had to orchestrate an unthinkable emergency rescue. They essentially forced a shotgun wedding, merging Credit Suisse into its biggest rival, UBS, and backed the whole thing with massive liquidity and state guarantees from the Swiss Federal Council. This wasn't your standard corporate merger. It was a desperate, multi-billion-dollar life raft deployed at the absolute 11th hour just to stop a total global financial meltdown. But here is the absolute core finding behind all that panic. The real threat wasn't just a lack of cash in the vault. When the Swiss regulator FINMA actually ran the autopsy later, they concluded the bank faced immediate insolvency because repeated scandals had completely torched market confidence. The money dried up simply because the trust evaporated. Clients weren't just withdrawing funds, they were actively fleeing a burning building. Section 1. First cracks. The failure of risk control. To really grasp how it collapsed, we kind of have to play financial detective for a minute. Look at the rapid-fire hits the bank took way before that fateful weekend. Pre-2021, you had the Greensill capital scandal. This massive supply chain finance firm implodes, and it heavily damages confidence in Credit Suisse's asset management. Clients lose billions. Then, boom, 2021 hits, and Archegos Capital Management, which was a highly secretive, massively leveraged family office, completely collapses. That single event vaporized over $5 billion for Credit Suisse in a matter of days. These weren't just a couple of bad trades. They were massive, blinking red warning lights for global investors, basically screaming that nobody was actually driving the bus. And that brings us to a really crucial concept: counterparty risk. In simple terms, it means trusting a risky client way too much for way too long with entirely too little protection. The Archegos collapse proved that Credit Suisse had a terrifying blind spot in its internal controls. They were handing over billions without asking the right questions, and that forced the entire market to ask a very dangerous question of their own. If a top-tier global bank can't even manage risk in its own backyard, what other toxic secrets are hiding in the shadows? Section 2. The vicious cycle, reputation as financial capital. There's a saying that absolutely nails this phase of the disaster. In banking, reputation is not decoration, it is capital. Think about it. If a tech company releases a bad smartphone or a car brand has a huge recall, they can usually survive, right? People might still buy their products the next year. But banks don't sell physical goods. They survive on one single invisible asset: confidence. Clients absolutely must believe their money is safe. So every bad headline, every leadership shakeup, and every scandal weakened the Credit Suisse brand, which meant the next crisis was going to be infinitely harder to survive. Credit Suisse knew they were bleeding trust, so they attempted this massive strategic pivot. They decided, okay, we need to shrink our risky, volatile, scandal-plagued investment banking wing. Instead, they wanted to double down on Swiss wealth management. The stable, boring, highly traditional side of the business that originally made them famous over a century ago. On paper, strategically speaking, it was a flawless plan to stop the bleeding. But here is the fatal flaw in that plan. They were trying to rebuild the airplane while simultaneously losing altitude. Strategy is only ever as good as its execution, and grand announcements don't mean a thing if the market simply doesn't believe you. The bank just couldn't convince terrified investors that this transformation was real or that it was happening fast enough.
They were desperately trying to pivot to safety, but they literally ran out of time and altitude before their trust hit zero.
Section 3. The systemic shock. Why the world panicked. The reason this specific collapse sent absolute shockwaves around the globe is that post-2008 banking regulations, the massive capital requirements and stress tests, were supposed to make this exact scenario literally impossible. But what we learned is that a modern bank failure isn't triggered by one bad spreadsheet or a single toxic asset. It's a devastating cocktail. It's poor risk control, repeated scandals, strategic confusion, client withdrawals, and total reputational collapse. When those interconnected weaknesses combine, they destroy trust far faster than any government regulator or central bank can step in to catch the falling knife. It becomes an absolute death spiral. First, your risk failures severely damage your reputation. That reputational hit causes clients to panic and pull their money, creating immense liquidity pressure. Suddenly, you're bleeding cash. Well, with no cash, your grand turnaround strategy is totally paralyzed. And that strategic weakness? It just breeds more fear, rapidly accelerating the final collapse. The ultimate leadership lesson here is that culture, risk, and strategy aren't separate departments functioning in silos. They are deeply, deeply interconnected. When one fails, it drags everything else down with it. Section 4. The post-mortem. Lessons from the fall. So what does the rest of the business world actually learn from this massive corporate autopsy? Well, first off, risk management has to have actual teeth. It cannot just be a symbolic compliance exercise. Second, your reputation isn't just PR, it is a very real, quantifiable financial risk. Third, you have to execute your strategy before you lose trust, because once that trust is gone, nobody cares about your future plans. Fourth, repeated scandals compound over time. You definitely do not get infinite second chances. And finally, absolutely no institution is protected by its history alone. A 160-year-old legacy of prestige means absolutely nothing if leadership falls asleep at the wheel. I really want to leave you with this one thought. Trust is built slowly. Risk accumulates quietly. Reputation breaks suddenly. When confidence truly evaporates, even a titan of global finance with seemingly endless resources and a sprawling global footprint can be entirely wiped off the map in a matter of days. It is a profound and honestly terrifying reminder of the hidden fragility of modern finance. Which leaves us with one incredibly uncomfortable question to ponder. If a 160-year-old giant can fall in a single weekend, despite all our modern safeguards, is any bank out there truly safe from a crisis of confidence? Thank you so much for joining me for this explainer. Keep asking questions and keep learning.